global banks may lose more than $6 billion from the downfall of United States-based Archegos Capital, the Reuters news agency reported, citing sources familiar with trades involving the U.S. investment firm, as regulators and investors feared the episode would reverberate more widely. Japan's Nomura and Credit Suisse of Switzerland warned of big losses from lending to Archegos for equity derivatives trades, triggering a worldwide sell-off in banking stocks. Morgan Stanley shares fell 2.6% and Goldman Sachs Group dropped 1.7%. Nomura shares closed down 16.3%, a record one-day drop, while Credit Suisse shares tumbled 14%, their biggest fall in a year. Deutsche Bank dropped 5% and UBS was off 3.8%. Losses at Archegos Capital Management, run by former Tiger Asia manager Bill Hwang, sparked a fire sale of stocks including ViacomCBS and Discovery on Friday, a source familiar with the matter said on Monday. This is a challenging time for the family office of Archegos Capital Management, our partners and employees, company spokesperson Karen Kessler said in a statement. All plans are being discussed as Mr. Hwang and the team determine the best path forward. Speculative environmentArchegos was unable to meet banks' calls for more collateral to secure equity swap trades they had partly financed. Swaps, or so-called contracts for difference, are transacted off exchanges, allowing managers like Hwang to amass exposure to publicly traded companies without having to declare it. After those positions fell sharply in value, lenders sold big blocks of securities to recoup what they were owed, the sources said. This is the kind of thing that happens in a speculative environment. You start finding that things go wrong, said Richard Bernstein, the chief executive of Richard Bernstein Advisors. When you have people making certain bets based on what has outperformed in the past and the tide turns, they get burned. The question is how much leverage they used. Nomura, Japan's largest investment bank, warned of a possible $2 billion loss, while Credit Suisse said a default on margin calls by a US-based fund could be highly significant and material to its first quarter results. Two sources said Credit Suisse's losses were likely to be at least $1 billion. One of them said the losses could reach $4 billion, a figure also reported by the Financial Times newspaper. Credit Suisse declined to comment. But several other banks appeared to be relatively unscathed. The financial effect on Goldman Sachs was immaterial, a separate source said. Likewise, Morgan Stanley, which sold $4 billion in stocks related to Archegos on Friday, did not incur significant losses, US TV network CNBC reported. Deutsche Bank said in a statement it had significantly lowered the risk of its exposure to Archegos without incurring any losses and was managing down its immaterial remaining client positions, on which it did not expect to incur a loss.